Advisor stays here with us. We had a bit of a chat before the break, and we continue engaging right now. David, thanks for being and staying here with us. Just before the break, you mentioned other countries that have suffered great financial shocks in the recent past, and you mentioned Ghana as well. And some would ask this evening, what makes us different as an economy?
We're not different. In fact, if you listen to the international commentaries, people are saying we are the next Ghana. In fact, it was told to me by a Senior World Bank official in December when we were visiting the US during the Africa Summit. So we're not different.
Really. That senior official told you
we are the next Ghana. Yeah. We are seen as the next Ghana. That was the situation.
How far away from the edge are we today?
Well, the thing with the markets is that this is outside of your control. The big thing that happened was the very sharp rise in the U.S. interest rates. The rise in U.S. interest rates in the last quarter from something like, I think the Fed rates are now something like 4.5%. It's the sharpest increase in the U.S. federal rates since it was established. So that's a huge financial shock, because if U.S. treasuries are earning almost 5%, the dollar is strengthening, all the money is flowing there. That way, headed that way. Is headed that way. Your currencies are weakening. Obviously, you are not, and then there's a war. There's the war. So, but the thing is, so you look at the countries which were already looking financially fragile, and we are one of those.
I like the way you're picking your words carefully. Financially fragile.
Yeah, fiscally fragile. But we are talking about our debt situation even before. It's something that we were quite conscious about. And we are very heavily extended in the financial markets, borrowing the Euro bonds. We have a lot of syndicated loans from the markets. So that market exposure means that the real risk comes when there is time to roll over your bonds, because you don't pay them off, you roll them over. And the markets have changed, so you are not able to roll over your bonds. So you need to be able to provide. Fortunately for us, we have quite a bit of lead time. We don't have any maturities, big maturities in the markets for another year.
You have a big maturity. Kenya has a 2024, $2 billion, $243 billion Kenya shilling Euro bond.
Yes, maturity.
Are we ready?
We are on top of it, yes. I believe we're on top of it, yes.
Okay.
Yeah. We're on top of it. I mean, we have lead time. If it was this December, to be honest, it's a timing issue. If it had been between now, I'm not sure that we would be in the situation that we are in. So part of it is really just a lack of timing, and that's the thing with Ghana, that their timings were probably off. But Ghana was a lot more extended than we are. It's also that we do have a stronger history of fiscal discipline than some of these countries. Ghana doesn't have a very good history of strong fiscal discipline.
Okay. So
there are various factors
for us. Before we jump away from the IMF discussion, some of our viewers listening to the word IMF and you celebrating getting more than, we had initially asked for $250 million US, but we got $400 million US in that program. There are some who say that Kenyans don't have very sweet memories of close IMF engagement. In fact, in the 1990s, IMF pushed the country to implement budget cuts, and you remember what happened there as well. Should we be celebrating a clean bill of health, quote unquote, from the IMF?
The IMF is an insurance policy. So nobody goes to the IMF when they are during good times. Okay? But if the IMF is not there when you are in trouble, then it's over the cliff. So sometimes when people are talking about the IMF and what the IMF does and all kind, they never ask themselves, where are we at that point? Where is the economy at that point where you are sort of calling in the IMF? You are in very severe distress. Yeah. So there is no time that IMF does not invite itself. IMF exists. It was created to maintain global financial stability.
I actually want to refer to your tweet. You said the IMF is a receiver manager acting for creditors.
Correct.
And it does not come uninvited. If you don't want IMF, run your economy properly. When will that be for us as a country?
No, it's not any point. There is no country, the UK, everybody, there is no country that at some point, because the IMF deals with financial crisis. Yeah, and there is no country that cannot be exposed to a financial crisis. So it's not about, like the kind of global financial crisis of 2007, bank failures and all of that. So the reason why the IMF does that is because we are part of the international financial system of the global economy. If you default on your obligations, that can have knock-on effects onto the global economy. So the IMF plays the role in the global economy that the central bank plays locally in terms of regulating banks. So if, for example, you have a bank which is about to go under and the central bank intervenes, why is the central bank intervening? It is intervening to prevent that crisis in that particular bank from spilling over into the entire financial system. Then you cannot have the shareholders or the members of that bank saying, oh, the central bank is a very bad institution. It is sort of taken over our bank. It is making us recover all sorts of things. Yeah. So that's the thing sometimes people don't contextualize. It exists to prevent the global financial system from having these snowballing effects of one country. Otherwise, it wasn't there. Every time there is a country that defaults on its payments, all of us get affected.
David Ndii, the last time I hosted you, I think, must have been in June, July last year.
Yeah, before the election.
Before the elections.
Correct.
And that time, I think I had you and someone from Azimio, and we were discussing manifestos.
Correct.
I still have the Kenya Kwanza manifesto. I have it here with me right now. And I distinctly remember the plan. Quick wins, short-term wins, medium-term, long-term. The quick wins were interventions that would have economic impact within 6 months. And the promise was in dairy, in seasonal crops, and in resolution of pending bills. Where are we on those three factors this evening?
Okay, let's, if you go a bit ahead of that, just the previous paragraph, we talk about the most immediate prioritizations, even before we come to that. And we have listed one, cost of living. And the next one, I think, is jobs. And number 3 is the public finances, that revenue base. And number 4, foreign exchange. I think number 5, inclusive growth. So if you put it in that context, I said when we came in, the first thing, in fact, that was most immediate was to restore our financial stability. And I was saying, obviously, if you don't do that, then the rest is a moot point. Secondly, if you recall, the first thing that we did when we talked about why we need to also remove the subsidies of fuel, incidentally, those subsidies of fuel are costing us 16 billion shillings a month already. I think we still owe 50 billion shillings to the oil marketing companies. But the first thing we did was there was short trains coming, and we rolled out a fertilizer subsidy program. So the first target was to it's not a quick win, it's a mitigation to deal with the food, the cost of living on the food side. So we did that. We've now started to see inflation coming down. November, I think 2 months in a row. We are now rolling out the fertilizer subsidy for the long rains. And we are targeting the maize-producing regions. Why? Because when we came in and we looked at our last harvest, our last harvest had a shortfall of 10 million bags. That shortfall was largely driven by the fact that the prices of fertilizer had really shot up because of the Ukraine war and all the COVID shocks, supply shocks. And fertilizer was going for 7,000 shillings. Farmers couldn't afford. Or at least if you could afford, if you had 5 acres, you could only afford for 1 acre. So we have gone out very aggressively to make sure that all the maize-growing counties that are going to plant maize this season have adequate fertilizer, and most farmers can actually expand their acreage. How
effective is the fertilizer subsidy program? Apologies for interrupting you. If this drought continues, how effective?
Well, you are not in control of that, but the truth is farmers will plant.
With or without rain, they will
plant and wait for rain. They always do. There will be some rain. I mean, not the entire sort of part of the country will be, and certainly some of the main maize-growing regions, you expect some reasonably. I mean, to say we don't share the rains and do nothing is not an option. So we're doing that. So on that particular part of the quick wins, we want to make sure that to the best of our ability, that this is the last season of high food prices.
That the country,
we have to stop to bring down the food prices.
And I'll come back to you and interrogate this a little bit further. I do have a few more news stories to go through, but let me read one question from one viewer who's asking this evening. To what extent will the global recession affect our economy? And it's 3 questions in one. Is it serious enough for Kenyan businesses to take drastic defensive actions? For example, could we have a bad business environment that leads to massive layoffs, as we've been seeing? How do you respond?
We believe we are on the recovery, because one of the things that we're doing, if you look at the reason why business has really suffered is because our growth has been driven by public spending, and mostly public infrastructure spending, which is debt financed. Part of the reason for our austerity program is so that government can pull back. And once we pull back, we then we stop crowding out the private sector from the credit market. That is already having an impact. Over the last 3 months, credit to the private sector growth has been less than 5% since around 2014, since we had the interest rate caps. For the last 3 months, we've seen it picking up. It's now past 10% per month. Per year on year, rather, 10% annually. So that effect of pulling back, we think, will then leave more space for the private sector. There is more headroom for the private sector to recover. Secondly, the strategies you're talking about are very much geared towards raising agricultural productivity. Now, agriculture has a very huge multiplier effect on private sector demand in the country, because if farmers have money, then they create a demand. Also, if you raise agricultural productivity, or at least agricultural production, bring down food prices, that means consumers have more disposable income. So we think that that's sort of framework, that framework will insulate us a little bit from the global recession. Our exports, which are the ones which are likely to be affected. Fortunately, they are not very sensitive, so much sensitive to the demand out there.
Okay.
Yep.
Okay, and I'll come back to interrogate further. Many questions are coming in, but let's take a few more news items, and then we'll be back with this man, Ndii.